It's over a half an hour till the opening bell on Wall Street. Joining us now on the market, Sarat Sethi, DCLA portfolio manager and a CNBC contributor. Just overall, Sarat, Happy New Year. You think it's too much to ask to get a similar year? Would you sign on to another 2023 if you could right now?
I would love to get another 2023, but I don't think we're going to get that much of an uptick. But I do think the year is going to end positive. Obviously, the last 6 weeks, we've had this huge run over 15%. So I think, the key now is earnings. Where are earnings going to go? How are companies going to actually talk about pricing, margins? I think that's going to be really important. And also balance sheets are going to be important. I mean, one of the things, Joe, we haven't really seen is, where are credit spreads going to end up at the end of the year? And right now, they're extremely tight. So credit market is telling you that things are much better than most people expect.
We sort of took any rate hikes off the table. Maybe they're still off. Maybe the possibility is that inflation's not conquered. What do you think?
I'm in the camp of I think it's going to be higher for longer. If you just look at kind of the fundamentals where companies are, you still have employment pretty high. Wages are already rebased, so it's pretty hard to take back wage increases. And I think the other thing, Joe, that we haven't really focused that much on, if you look at the commodity, the energy side, especially commodities, we are, when you talk about copper, aluminum, steel, it's not that they have pricing. It's just that we don't have enough supply going forward. And I think that's also going to add to the inflationary pressure. Then you look at supply chain, you look at things about shipping, not just, hey, what's going on overseas on the two wars we have, but look at what's going on in the canal. So I think all that said, the Fed's going to be hard-pressed to get the 6 cuts. I think you'll get a couple at the end of the year. And the markets will have to reprice that, especially for the growthy stocks that are taking into account, 2% again.
Okay, so 2 instead of 6 and back-end loaded. The market might not be set up, but that would be disappointing to the market.
It absolutely would, and you could get a correction, but I think the correction would come from some of the stocks that are priced, way above where the market is. So I would look at healthcare. I would look at, defensives like staples, utilities, commodities. Not to say you don't want to be in the Mag 7. You can, but be diversified, because I think having some of the other areas in your portfolio, growth at reasonable prices, and some of the stocks that just have been out of favor. I mean, you look at life science companies, you look at some of the healthcare bio companies, nobody wanted to own them last year. So I think those are some good opportunities to be in.
Some people were saying that it's safe to load up on duration and in bonds at this point with at least a portion of your portfolio. Do you ever do that, or you just strictly tell people what stocks to buy, Sarat?
No, we have them in our balanced accounts, depending on the client's risk profile. And I would agree, for those clients who need protection and they don't want the volatility, I think you can go out, but I wouldn't go out more than 3 to 5 years. I think you do get paid to go out there, but be very careful as to the credit, because again, as I mentioned earlier, the spreads are still very tight. So if you're going out more than a couple of years, you want to make sure that the companies that you own have good balance sheets and good cash flow, because you can get 5 to 7% going out 3 to 5 years. And if you look at the curve, it's saying it's going to be a lot lower in a couple of years. So yes, I would do that, but I would do that based on your risk profile. If you're a growth investor and you're young, I would say equities are still the way to go. But if you're retired or you need your money, absolutely, there's a lot of opportunity. I think, Joe, that's where some of the money's coming out of the market as well, because investors are seeing, hey, I can get 5-6% on pretty safe companies going out 3 to 5 years.